risk appetite was given a strong boost overnight by European Central Bank President Draghi's bond buying plan, as well as solid economic data from the US. The S&P 500 soared to closer to four-year high of 1432, and that was followed by a broad-based rally in Asian equities. The Aussie has so far been the biggest winner and enjoys a strong rebound against the dollar and euro. The Canadian dollar also followed the risk rally, but strength was slightly weaker than the Aussie due to the limited crude oil pullback. Whilst the dollar was pressured, the Japanese yen was even weaker as yen crosses were given additional boost from a strong rebound in US Treasury yields. Focus will now turn to the non-farm payroll report from the US today, for the needed fuel to extend the risk rally. The ECB left the main refinancing rate unchanged at 0.75%, compared with the expectations of a rate cut of 25 base points. Policymakers believe that this is not an appropriate time to lower interest rates as economic weakness has been anticipated. Meanwhile, President Draghi stated at the press conference that officials have basically agreed on an unlimited bond purchase program. Despite objections by a member, the program is expected to be able to help address severe distortions in government bond markets which originate from, in particular, unfounded fears on the part of investors of the reversibility of the euro. According to Draghi, purchases would be fully sterilized, suggesting that the program would not trigger inflation pressure. The ECB also affirmed that purchases would not have seniority. The stronger-than-expected automatic data processing employment report, which showed a 201,000 expansion in the private sector job market in August, lifted expectations for today's NFP. Economists expect the non-farm payroll report to show a 127,000 expansion in August, with unemployment rate unchanged at 8.3%. While the employment component of ISM manufacturing dropped from 52.0 to 51.6 in August, the improvement in the employment component of ISM services, which jumped from 49.3 to 53.8, was encouraging. An upside surprise in today's NFP is possible, and in that case, the Japanese yen would likely be sold off further. A key implication of the job data is the chance of QE3 from the Fed. Bernanke has clearly said that the employment market was a grave concern, and that would be the major factor in determining the timing of additional stimulus. It's a bit tricky to predict the reactions of the stock markets and commodity currencies on the job figures, as a good number would reduce the odds of more quantitative easing. But for sure, yields would jump in that scenario and should take yen crosses higher. Meanwhile, a long list of key economic data will also be released today. That includes Swiss unemployment figures, foreign currency reserves, UK industrial and manufacturing production, and German trade balance and industrial production figures. Also, Canada will release the employment report, which is expected to show a growth of 11,000 in August, with unemployment rate unchanged at 7.3%. A double boost of US and Canadian job data would possibly send the US dollar, Canadian dollar through the important 0.9799 support level. Canada will also release building permits and IVPMI. British pound, Japanese yen daily outlook rising to as high as 125.88 so far. The break of 125.82 resistance confirmed resumption of the rebound from 118.82. Intraday bias is back on the upside, and a further rise should be seen to a 100% projection of 118.82 to 125.82 from 120.82 at 127.82 next. On the downside, a break of the 123.69 support is needed to indicate short-term topping. Otherwise, we'll stay bullish even in the case of a retreat. In the bigger picture, at this point, we'd like to maintain that price actions from 116.83 are corrective in nature so far. A rise from 118.82 could be the third leg of the pattern from 116.83 and might target 133.48 and above. But this is far from being certain. After all, the likely scenario is that we'll see more range trading between 116.83 and 140.02 ahead before an eventual downside breakout. We'll favor this view as long as the 140.02 resistance holds.